Oh, look, everything that's happened in the past couple of weeks, and volatility runs in both directions, haven't altered, my view on where the economy is headed. And without trying to time it to the week or the month, I think we have to continue to play the probabilities. And all I've been saying all along is that we have had 13 Fed tightening cycles in the post-World War II experience. 10 landed the economy in recession, and 3 didn't. Maybe this will be the 4th. What I'm saying is that if you look at the historical pattern, 80% of the time in the past, the economy with a lag fell into recession. And I'm not going to say that it's an easy call to make. That's why most economists, in fact, the Fed on the eve of the recession, when you go back to the transcripts and you look at the Green Book that the Fed staffers present to the FOMC, the Fed itself never sees the recession coming the month it actually starts. But it's not necessarily just a call on the yield curve itself. It's really the reality that when you look at the Fed's balance sheet movement and the rise in rates, collectively the Fed has raised rates more than 300 basis points this cycle into the context of the most leveraged economy we've ever had. And that has lagged impacts on GDP. So this isn't a story today. It's a story in the next couple of quarters that the lagged impact of these rate increases are going to bite the economy, given how leveraged it is, and bite it pretty hard. And I think that's really been one of the early messages from the markets over the course of the past several months.
Embedded in what you're saying, David, are you concerned about the impact on these balance sheets of rising rates? I mean, do you think that companies may not be able to service their debt eventually?
Well, I think that's, that's really the key question. It really comes down to, I guess, which asset class you want to be invested in for the coming year. Because there are some things that we do know. We do know that there are lags between what the Fed does and the time it hits the economy. We also know, and this is pertinent to your question, that this is the first year, 2019, of literally a 4-year tsunami of corporate debt refinancings as we pay the piper for all the issuance that took place to buy back all that stock. And it will take place at higher interest rates than where the debt was originated. It's unclear as to whether this is going to cause, a whole crisis of fallen angels or all those triple Bs that slip into junk bond status. There is another narrative that you can accept, which is that companies, instead of defaulting or instead of risking being downgraded, which affects their cost of capital, will take advantage this year of whatever cash flows that they generate to retire debt or certainly towards servicing their debt. That comes at the expense of a lot of the things that have propelled the stock market this cycle. It wasn't just the economy. It was the weakest economic cycle of all time. Stock buybacks will pay the price. Dividend payouts will pay the price. But something else that pays the price, as we saw in 2000, 2001, 2002, is I think that the defining features of the recession that I'm expecting, and I'm not going to say that it's a sure thing, but it's my base case, is that this will be a year of corporate deleveraging, and the first leg will be capital spending.